Let's start. What is whole life insurance? Whole life insurance is a type of permanent life insurance. It lasts as long as the premiums are paid. The policyholder can withdraw the policy or borrow at any time. This policy has a 100-year maturity. If the insured survives beyond the maturity age, the policy matures. In the event of the insured's death, the nominee receives the aforementioned amount. This plan's death benefit is tax-free. On the other hand, a whole life policy is the simplest form of permanent life insurance and provides coverage for your entire life as long as payments are paid. Unlike term, it has a cash value component. A policy's cash value rises tax-deferred over time, so you don't pay taxes on the gains. Other benefits for permanent life insurance. The premium remains the same for life. Guaranteed death benefit. Guaranteed cash value growth. How does whole life insurance work? Knowing how whole life insurance work will help you decide if they are right for you. A complete life plan can be purchased for a one-time payment, monthly or yearly. If you purchase a unit-linked whole life policy, your funds will be used to purchase life insurance and pay the sum assured amount, with the remaining funds being invested in an investment fund. In the case of flexible whole life policies, the insurer will examine the policy on a regular basis to see if the policy's value is comparable to the cost of the life insurance it is providing. If the remainder of the money is put in an investment fund and that is not doing well enough to meet the cost of benefits, your insurer may advise you to either reduce the amount of your sum insured or increase your regular contribution. Customers can also get coverage for specific illnesses or disabilities with whole life insurance policies. What does whole life insurance cover? Whole life insurance provides death benefit if you qualify for this policy and as long as scheduled payments are made. Some causes of death may be excluded, and this will be stated in your policy. Your beneficiary can utilize the death benefit to cover expenses such as 1. Medical bills. 2. Mortgage payments. 3. Education expenses. 4. Debt. 5. Necessities, for example, gas, food, and utilities. 6. Final costs, like funeral, cemetery, and burial fees. What are the advantages of whole life insurance policy? Whole life insurance may be a useful alternative for those seeking long-term coverage. When looking for life insurance, you have many alternatives based on your personal needs and budget. There are main 3 benefits of whole life insurance. 1. Lifetime protection. If you buy a 20-year term policy at the age of 30 and when you become 50s, your term policy will expire. You have to get another policy, but the premium may be greater based on your health condition and new rate of the premium. Whereas, whole life coverage has a big plus point. It gives you lifelong coverage with same premiums that won't grow, won't expire, and won't be cancelled. To keep the policy in force, premiums must be paid on schedule. 2. Cash value. One of the primary benefits of purchasing whole life insurance is that it provides cash value. With whole life, you can borrow against the cash value of your insurance. If you die unexpectedly, any leftover loan balance on your whole life policy may be removed from your death benefit. Your policy's loan balances earn interest while you're alive. 3. Flexibility. Another advantage of whole life insurance is its flexibility. You can use the cash value that can accumulate over time for a variety of reasons. You could alternatively leave it alone, perhaps boosting your policy's cash worth over time. Types of whole life insurance policy. There are several types of whole life insurance policies available on the market, each designed to meet certain needs. Let's discuss about each, to see which one best suits your needs. 1. Non-participating whole life insurance. A non-participating whole life policy has a constant premium and face value. The fixed fees and minimal out-of-pocket premiums are advantages of such a coverage. Non-participating policies do not pay dividends. 2. Participating whole life policy. A participating whole life policy pays dividends. Dividends represent the company's extra earnings from investments, savings from expenses, and favorable mortality of the company. There is no guarantee of dividends. If dividends are given, they will be paid in cash and used to reduce the premium payment amount, or they will be allowed to accumulate and earn interest. The dividends can also be used to buy paid-up extra insurance to increase the face amount given. Individuals can pick from numerous types of whole life policies under the two broad categories of participating and non-participating. 1. Level premium whole life insurance. Level premium whole life insurance requires constant premium payments throughout the insured's life. The collected premiums, in the early stages, cover the costs of insurance protection. The surplus money, plus interest, will help to cover any future premium shortages when the annual premium payments may not be enough to meet the insurance expenses. 2. Limited payment whole life insurance. Limited payment whole life insurance requires policyholder to pay premiums for a limited time to provide lifetime protection. Customers pay premiums for a certain number of years 10, 20, etc. 3. Single premium whole life insurance. Individuals who purchase single premium whole life insurance must pay the premium in one flat sum. The payment must be made at the time of issue, making the insurance completely paid up with no future premium payments required. Depending on the amount of the lump sum premium, the policy may have high loan value and instant cash value. 4. Indeterminate premium whole life insurance. An indeterminate premium whole life policy differs from a standard whole life policy in that it allows policyholders to alter their premiums. The insurer will charge policyholders a current premium based on current earnings, expenses, and mortality. If the above estimations change, the insurer will alter the premium amount charged to the policyholder. Thanks for joining us. Have a nice day.